Time for the market report on the downswing last week.
That's right, and that's not entirely a bad thing, and we'll get into why. But first, the numbers. Down, as we said, we'll see which commodities hit the most. And then in our row report, what do the grain markets look like and what does it tell us? And finally, we look at the cattle markets to see what's making the prices move. Markets on a downswing last week. Most commodities we followed down in prices. Not really a bad thing considering prices have been high for months. Let's take a look. Last week's biggest loss, wheat down 47.5 cents. We'll get into more detail in our row report, but supply seems to be the reason for it. Last week's only gain, cotton up 2.28 cents. Looks like, at least in the cotton markets, we still have some room to grow in prices, so to speak. So, in this week's row report, we look into dropping grain prices. Wheat, soybeans, corn, all down this past week. Why is that? Well, according to market analyst Mark Gold, it has to do with weather and yields. Specifically, good weather in grain country signals a potentially fine crop this year. Internationally, we've seen stocks go up, which means there's no shortage, which means prices have no reason to be high.
You know, first of all, we had much better weather in the United States. All this Arctic blast and this typhoon type weather hitting the West Coast is ultimately going to help a lot of things. All that moisture that moved across the Midwest, we're going to see these river levels come up, replenish a lot of soil moisture, with the big exception being western Kansas. They are still dry and need a lot of moisture. Well, you've got Australia looking at maybe a record crop. It's going to be huge. You've got Russia selling wheat wherever they can sell it. You do have the concern of the ongoing war between Russia and Ukraine. We've got relatively cheap wheat out there. These current rains and moisture and the snow cover we've had in the U.S. has knocked out the threat of winter kill, really. And again, with the exception of western Kansas, we're going to have some pretty good wheat in this country. You look at the wheat, the high in $12.50, $13 range, back down to $7.50. That's one heck of a break in this market. And doesn't mean it can't go even lower. Look at these export numbers. They're almost non-existent. You know, 120,000 metric tons of wheat going out the door. It's nothing. The dollar on Friday put in a remarkable move. It was up a point, a full penny, then it was down more than a full penny, but still closed higher on the week. The dollar could be in some trouble here, and that may help things long run. But we just don't have any export demand for our wheat, and it's killing our market. Just terrible numbers out here. Without China buying, Mexico's stepped up a little bit to the plate and kind of helped us a little bit here, but it's not what China can do. And if anybody wants to know if China's in trouble with this COVID situation, just look at what's happening there. They've stopped announcing how many cases, how many deaths. They just increased their crude oil export quotas, which tells us that their economy is slowing down dramatically. So, you know, where's the demand going to come from if we've knocked China out of the box? Plus, the world's going to be bringing more and more grain to the table over the next couple of months. It's a tough market.
In the cattle markets, prices down last week, although they're still relatively high. 19.5 cents higher than this time last year, as a matter of fact. So, according to Mark Gold, it looks like we've seen the top of cattle prices, despite cattle on feed being down. That's not set in stone, of course, but it does mean that futures could trend downward from here.
We've had, obviously, a strong cash market in the retail level, but the packers haven't been willing to pay up, even though there aren't that many cattle around. So why would the market break? I think it's a couple of things. Number one, this is a long time ago, but when I was back in college in the mid-'70s, I did a study for one of the professors about cattle relationships and how many times we would make highs in the cattle market in this third or fourth Friday of the year. And that's always stuck in the back of my mind. And when we were on these contract highs last Thursday and Friday, I'm thinking, I don't know if it's going up or down or not, but I do know this is a great opportunity to buy some puts here. So I think that's part of the technical scene that's going on. And right now, after the last couple of days, certainly looks a little toppy. The other thing I think that's going on is that, you know, even though the Dow is strong, I think people are concerned about world economies. We're We know it's tough to pull cattle now, and that the placement numbers are going to be tough for a while. But sometimes it's a futures market. We build these things in ahead of time, and maybe we've built enough in for the time being. I think feeders are going to be as much a function of the corn market as anything else. But I think cattle, hogs, and fat cattle, feeder cattle, and hogs all have a propensity, in my opinion, to go down because the fund rebalancing is going to start on Monday, and we expect the funds to be selling corn, wheat, beans, cattle, hogs, and feeder cattle. So I don't think that's a positive for these markets.
And that's it for a deeper look into the markets. Looks like a market reset in the works for 2023, albeit a slow one. Things keep going this way shows supplies are coming back.